All right, so this class is the second in the series. We're going to be doing channels and trends. This will be a relatively short one again, as it's more so fundamental than advanced stuff. It's something that doesn't need a lot of time to go into, but it's definitely something that you should know. And then this will most likely be the end of the really beginner stuff, and next week we'll start more so on the advanced or more advanced topics. I can't remember off the top of my head where it is. All right, so the agenda for today are what are channels and trends, going over what they are, how to find channels and trends, live charting with that as well, and then we'll close it with how to use them, trading strategies, and then a Q&A at the end. So channels and trends are somewhat the same thing. They're very similar. However, they're actually different. Channels are locations in a stock's price where movement is confined to an area between two parallel lines. So if you look to the right here, there's three kinds: an up channel, a down channel, and a sideways channel. Up channel is obviously when the channel's in an uptrend. The down channel is when the channel's in a downtrend, and the sideways channel is when the channel's just sideways. These again are two parallel lines, so they require two lines to be a channel, one line to be a trend. Trends are locations in a stock's price where movement struggles to proceed on a slanted basis. So if you remember from the first class, I said that significant levels are locations in a stock's price where movement struggles to proceed, and those are just horizontal lines. This is on a slanted basis. You can have a horizontal trend, but at that point it's just a support or resistance level. So these are higher lows, higher highs, lower lows, lower highs. As you can see on the chart on the right, it's a descending trend on the SPX one-day chart, and then an ascending trend on the bottom right. So it's a smaller trend, but it's there. These you can do with one singular line. They can have two, but again, channels are where the lines are parallel. Trends, they kind of vary. They don't need to be parallel. They can form into like an ascending triangle, ascending wedge. Those are technically trends. Whereas channels, you need those parallel lines for it to be a channel. So I'd refer to them as significant levels. This is the first right here on channels. So as you can see in the chart to the left, they can be formed on a much longer time frame. You can also have them all the way down to a 5-minute. Obviously, if you remember from last class, the lower the time frame, the less significant it is. The higher the time frame, the more significant. So if you have a channel on a 5-minute, that's going to be much less significant than a channel on a daily or 4-hour chart. So you can buy options for weeks out, play the moves between these trend lines. You can buy them on the 5-minute, the 10-minute, whatever time frame you want. But playing those, you need to play it on the time frame that you're watching the trend on. So in this case, it was on a daily, so we would have played on a daily trend or daily time frame. Again, significant levels, I'd refer to them as trends. I refer to trends as such. Similar to channels, but only require one line to be formed. They can have two lines, but channels need to have at least two lines. Trends only need one to be formed. They can be played the same way, but only in one direction. Similar to channels, you can buy options for weeks out and play the moves between trend lines. They also range from 5-minute to daily. So they're very similar, and that's why they're being covered today in the same class. But they do have their differences. So how to play them: you wait for taps on your trend line or trend. You can either wait for that or wait for a trend line on the channels. Enter your position with an expected time frame, and I'll cover that in the next slide. And your stop loss will be a close over the time frame that you're on, so whether that be the 5-minute or the daily. A close above that trend line invalidates it. So every circle here on the chart, and in the first class I also said that you need at least 2 touches to validate a trend or validate a level, and 3 touches really confirms that. So That's why you don't see the circles starting up here all the way at the top. You see them starting after the third, fourth, or fifth bounce, because that validates the channel in this case. So every circle you see on here was a area that you could have played. So you could have entered puts up here for a push down to the bottom trend line, up to the top again, back and forth. So you're kind of ping-ponging between the trend lines and the channel. The invalidation is, again, here where you have a time frame close under, you have a candle close under whatever time frame you're on. In this case, it was the daily. So this candle right here would have invalidated you. The previous candle here, you would still be in the puts that you should have entered on this last circle. So for that time frame that I mentioned in the previous slide, to get that, you want to use your trend line tool. It's on the top left of Trading View. You draw a line, draw that trend line between the two data points here. So the bounce off the bottom trend and a rejection off the top trend. You want to draw that time, you want to draw that trend line between those, and then click on the completed trend line, and you should see at the bottom of your chart that it will disclose what dates the trend line goes to. So in this case, it was 17 days. So you would want to enter, in this case, you would want to enter calls for about 3 weeks out, 4 weeks out, if you want to be a little safer. You don't want to be entering calls for like a week out, because you could still be in the position before it bounces. It did take 5 days for this to bounce off of this bottom trend on the channel. And then it did break up to the top, but it took, again, that 17 days in this case. And you can always go longer. So you never want to be shorter than what the expected time frame is. You always want to be longer, or at least equal to what it is. And in the live charting, I'll get into how you do that again. So that is it for the quick slides there. Let me get into some live charts now. So I'll clear this real quick. Remove 11 drawings. There we go. So if we go in the hourly here, we can see a pretty defined trend. Even on the daily, we can go this to this time frame. So this is the Soxhlet chart, SOXL, and the daily. So you get your trend line tool up here again. This is how you draw the channels and trends. For instance, this would be a trend right here because you only have one line, whereas this would be a channel because you have two parallel lines. If the trend that you have is something like this, where it's an ascending triangle, the lines aren't parallel, so this is just a trend. This isn't a channel. You want those lines to be parallel in order for it to be a channel. So in this case, you can see that it's validated after the second touch here. You also have a third and fourth touch, and then another touch at the bottom trend. So the bottom trend line's validated, the top one's validated. This is a channel because we have two parallel lines. You can go ahead and circle where you would have entered, and I can show you real quick. Because this is the beginning of one, you'd want to wait for, I'd say, this tap right here, because again, you want those 2 to 3 taps to confirm that it's valid. If you just have one tap like this, you could come over here and draw anything off of this, and you don't have enough data yet to validate it or invalidate it. So you put circles on where you would have entered, and I posted this chart earlier in the Discord today. My expectation for this pivot right here is for Soxhlet to come down back to this bottom trend line and then have another pivot from there. So I go ahead and draw that. That would be my expected trade. If I wanted to, I would enter puts, and then to get that expected time frame, what you want to do is your trend line tool up here in the top left, you draw it from one circle, flat line to the next one, and then you click on the line at the bottom. It will show you Tuesday, October 18th, 2022 to Tuesday, November 15th, 2022. So it's almost a month for it to reach the top trend from the bottom trend line. And then you do the same thing for the next one. I am going to go ahead and have this move as one move here, and that's how you get your time frame. So this is a great example of why you don't want to be under what the expected time frame is. So in this case, it was a month. The second one, it was about a month and a half, so 6 weeks. You always want to go over what the expected time frame is for a bounce, and then you can go ahead and do it again for the last one, and that will be about a month again. So I'd say the average on this is probably 5 weeks is what you want to give yourself for a time frame. So in this case, because we're at the top of the trend, the top of the channel, you go ahead and draw another line out, and where your expected pivot or your expected tap on the bottom trend line of the channel is going to be, again, just over a month. So I would set an order for puts for 5 weeks out in this case, and I would aim for anywhere below, I'd say 12. Price target on the dot would be 11.30. So that would be a, get the percent tool here. That would be a 27% decrease in share price, so $4. So I could buy a $11 put, a $12 put for 5 weeks out, and my invalidation would be if we had a close above this trend line. So there it is. If we had a candle that came up on the daily and closed above that, that would invalidate me and I would take the stop loss. My validation is just a rejection off of this top trend line. And they're relatively easy to find, so we'll go over that now. You can trade them again on the 5 minute too. So on SPX for today and yesterday, there was a 5 minute channel. We got those two parallel lines. Could also say that it's a trend because the lines, if you draw it from the top of this candle over here, the lines do stop going parallel. They are coming to a point and they'll eventually cross. So this could be a trend, just a trend. Again, they're very similar. As long as you have the channel or trend drawn, you'll be fine either way. Channels, because the lines are parallel, you're able to trade the same distance from top to the bottom, whereas trends, it'll get tighter and tighter the longer they last, and then it's a little more difficult to get that same percent return on the trends. So in this case, we're on the 5 minute. I would circle all the areas that I would have taken some calls or puts. So we have bounces off all of these levels here. This one's a little bit more difficult because it's on a shorter time frame, so you don't have that. You can use the trend line to get your expected time frame. So because it's on the 5 minute, you're most likely just going to enter weeklies or daily 0-day contracts. In this case, it took SPX 6 hours or 4 hours to bounce from the bottom trend line to the top trend line. That would be your time frame. For the second one the first bounce to the second bounce, it was overnight, so it was 24 hours. But this is how you get that expected time frame. I really want to hammer that in. You don't want to be trading in a time frame underneath what your expected bounce from bottom to top will be, or rejection from top to bottom. And this one was definitely a favorite. So Octa also had the same trend on the 5 minute. I'd say this is a trend because it's not parallel. It's going to start getting tighter and tighter up here. So eventually they will cross, and the price action just starts going from, I can't find these tools right now. The price action will eventually just start getting really narrow, and then it's going to have a break one way or the other. So something like this. But on the daily time frame, and this was back in early to mid last year that we played this. It was on a daily time frame. It was a very significant channel that we had. You can see the parallel lines. It's a downtrend because the channel's going down. This would be an uptrend right here because the channel's going up. And then this would just be your sideways channel right here. I'd say this is a trend because they're not parallel. You have your sideways channel right here. the price is getting narrower and narrower as it goes up. But so what we did here was we used that tool, the trendline tool, to draw the distances between trendline bounces, excuse me. So you just draw those in. That gives you your expected time frame for how long it's going to take for one bounce to reach the other, or one tap to reach the other tap. You do that all the way down, and that will in this case, I think this gave us a good 3 to 4 trades. The longer they last, the more invalidated they get. So you can see at the top here was relatively consistent with how long it took to reach one line from the other, whereas at the bottom it started getting pretty messy, and then it ultimately invalidated itself. So they don't last forever. They much like the intraday trends or the intraday significant levels we talked about last week, they lose their significance the longer they last. That's not the case always, but it does happen. It's like a decay factor. If we go in the daily here on SPX, this is the example I had for that slide earlier. So this is a descending trend because the price is going down. The price is struggling to continue price action or continue movement every time it hits this trend. It's not parallel, so it's not a channel because we don't have a parallel line going down with it. If we did, then this would be a descending channel. Again, it's not because it's not parallel. And then we have an ascending trend down here because the price is struggling to continue going down every time it hits this slanted up, this trend line. So the way that you would play this is very similar to how you would play the channel. What you would do is you circle everywhere that you would want to get in. You don't need to use the time frame because you don't have a bottom line that's going to bounce off. You would just play this every time it taps this line, every time it taps your trend line. In this case, you would play puts, and you would have just a price target of going down. You can set your price target wherever you want, but if it tapped this trend line, I would just buy puts for 2, 3, 4 weeks out. It doesn't really matter because there's no exact time frame on how long it's going to take to go down. It just has a relatively sharp rejection every time it hits that trend line. And then your invalidation is like down here where it breaks it on that daily time frame that you're looking at. So you would take a loss on this position right here. And then I think I might have some other ones to look at in the 5 minute. You can get them on any time frame you want. So right here we have, I'd say an ascending trend because they're not parallel. You want to also start from the same point where you draw them. So if you start down here, you want to start your top trend at the same point. You don't want to start from like back here and then say that this is one trend or one channel, because you want to start at the same point. So in this case, I would say it's an ascending trend because it's not parallel again. We could put the time frame on here, but because it's a trend line, we can just say if the price bounces or rejects off X trend line, we can take X option and play it for however long you want. In this case, I would say if for the bounces on the bottom, you can take calls here and then puts for 1-2 weeks out. It's on the 15-minute time frame, so it's not a large time frame. And then if we go all the way down to the 1 minute, you can get the same channels trends on the 1 minute. Again, because it's such a small time frame, it's going to be less significant than anything else. But you can say right here that we have almost from the same spot. You can say right here we have a channel going up. The lines are parallel. It's on a 1 minute, so it's not going to last very long. This was probably an hour, if I had to guess, 2 hours maybe. So to play this, you just do the same thing. Calls at the top trend, calls at the bottom trend, puts at the top trend, and then you just play the movements between them. and it started getting invalidated the later on the trend went, and then it completely busted out of it right here. So I see 2 questions. Can you set alerts on trend line breaks or on a touch point? It's difficult to do, but you can. The reason it's difficult is because you can only set alerts for flat prices. So you can't draw a trend on your brokerage and say, if it hits this line, alert me. You can only set those on flat levels, those significant levels we talked about last time. So you can do it on a Webull, Robinhood. If you have a flat level, so 42.94 on SPX here, alert me if the price goes above this level. The reason that you can't do it with trends is because sometimes you'll draw them incorrectly, so you might be off by one candle or 10 degrees on the angle, and that's going to vary the longer it goes on. The best thing I'd say to do is set that price target we talked about. So in this case on Soxel, I expect this price to go to 11.30 if it hits that bottom trend. If it breaks this top trend, it should be at least above 15.87. So I would set an alert for 15.87, alert me if the price goes over this. If that happens, then you can remember, hey, I got to go check this trend I have on Soxel, see if it's going to reject here, if it's going to break. I think that's the best solution for that. Again, it's kind of difficult to set an alert or a reminder for an ascending trend or ascending line like this, or a descending line. Either way, slanted lines are difficult to get your brokerage to tell you if they hit. And then the second question, how do you set up your screen so you can keep a tab on so many trends? I know that's a personal preference and is based off your monitor setup. So this is one monitor. This is just my laptop that I trade on. So I have all these different tabs. What I do is I just open another trading view tab and click whatever stock I want, and then just hover between them. So it doesn't take very long. It's not like the price is gonna drastically change between the 2 seconds it takes for me to look at one chart or the other. So I'll get one more here. These are a lot simpler to chart than the significant levels. So last time, as I said, significant levels, you need to be relatively spot on with them. You can't really be off with where you assign your level. So like 11.35 on Soxel, you can see we have several bounces off of this 11.35 level here, and then one good break, another break to the upside. Trend lines are relatively simple to draw. You just draw a long. It's easier to do on longer time frames. You just draw a long where multiple candles hit. You don't need to be as precise with them. You do need to be somewhat precise because you don't want to have a channel that's drawn like this or like this where you're off by all of these candles right here. You want to make sure you're including. You can include some wicks, you can include some bodies. I think a combination of the two is fine. You don't want to only include the bodies. If you do, then you only include the bodies for the whole trend, and then that would make it look like something like this. And then it just gets messy. If you include both the candle wicks and the bodies of the candle themselves, you'll get a nice clear trend like this. So you can, on TQQ, you can chart these on any stock too. So I'll just pull up a random one. I don't think I have anything on IWM. So this is on a daily time frame, completely naked chart. I would say that we have a descending trend right here that we recently broke out of at the tail end. Let's see. They're easier to look at in past years as well, where the price action's relatively clean. So I'd say this is more so something that you do in a directional market rather than the market that we're in right now, which is up, down, up, down, up, down. Whereas you can see in 2020, Is this 2017 to 2018? We had a very clear channel up, 2 parallel lines going up, and you could trade off the bounces off the bottom and top. So puts at the top, calls at the bottom, and then it gets a little sloppy over here as well. Another chart too, so I'm going Disney. I already have stuff on Disney. Shoot. Nike maybe? I already got stuff on Nike too. We can still try. I don't know a stock that I don't have anything drawn on. PNW, there we go. So bottom trend line here. You use the same tool, that's why I keep saying trend line as well. If that caused any confusion. You use the same tool, the top left trend line tool. You can also use arrows. This one just puts an arrow at the end of it. Same thing. It's not really necessary. You can also use any of these. The horizontal line and horizontal ray make a perfect line out as far to the right from wherever you click. And then the vertical line, this makes a vertical line from wherever you click. This one's pretty useless. It's only useful if you're trading like within a range and you want to only get the data points between these two lines. But you always use the trend line whenever you're charting these channels and trends. So right here, there's also broadening ones for trends. So for channels, I know I said that it needs to be parallel. You can also have broadening trend lines like this. Obviously, the further out they go, the less valid it's going to be. But at the beginning, you can play it. Puts off the top trend line, calls off the bottom. Eventually, it's going to stop making such drastic moves. In this case, it's a pretty wide angle that we have at the base here. I'd say probably 30 degrees, 30, 45 degrees. So it's unrealistic for the price to continue all the way up to the top and bottom. That's why I said the longer the trend line goes on, the more invalidated it's going to get. Another question. If you're day trading, what do you recommend for time frame? I'd say that the 5 minute, the 15 minute for day trading, and then for swings or longer time frames, you'd want to look at the hourly, 4 hour, daily. I wouldn't day trade on a 4 hour chart or hour chart. The max I would personally go is the 15 minute. I don't usually go below the 5 minute because, again, the smaller time frame you go, the less significant the moves are going to be. This is on the 1 minute. There's so many candlesticks on the day that it's difficult for it to validate. Whereas on the 3 minute, it's going to be a little more significant. The 5 minute is going to be more significant than that, so on. And this is a good example here too. So we have a ascending trend right here. You even draw it like this. So it's a little bit broadening. The top trend line's relatively flat. There we go. So it's pretty flat top trend, but the bottom one's broadening a little bit. So the further this goes on, the less valid it's going to be. But you can have your expectations like this. And if it continued on, it'd likely do something like that. Or you have a rejection off the top trend line after a bounce off the bottom. Again, the longer it goes on, the less valid it's going to be. And then one more minor thing as well is you can also go on the daily. So I drew this one today on DraftKings. And this one's a little bit more complex. It's not the straight lines that everyone likes. You can, in some cases, have curled lines. So in this case, you have to hand draw it in. You don't have a straight line tool to use. But as long as they're parallel, that's pretty crappy. Hold on, let me redraw that. As long as they're parallel, they can still validate it. So this looks like a curl up to me in price action on DraftKings. So it's not a flat trend line like over here where we had a descending trend where it started getting tighter and tighter and then eventually broke out. And in this case, you could have played all of these bounces the percent gain goes down the tighter it gets, but at the beginning you can play like calls from here up to the top, calls from here up to the top again, puts down, calls up, puts down, so on. But back to this, oops. You can draw them, you can hand draw them in, and I don't recommend this if this is new to you. This is something to practice before doing. So based off this channel that I have drawn, it's 2 parallel lines, so it's a channel. I'm expecting the price of DraftKings to do something like this. And then the price should start curling back up to make higher lows and higher highs. So I'm going to extend this out a little bit. There we go. So I have my time frame. Let me put the circles on. Hold on. So I have my time frames here from bounces and rejections. There we go. Bang. And bang. So I use my trend line tool to calculate the distance between these bounces and rejections. So in this case down here, it was Friday, September 16th to Wednesday, October 12th. So this was just under a month to get that move. Second one was October 12th to November 2nd. So about 2 weeks, a little shorter. This one, I would invalidate this just because it's earnings, but it did stay within the trend. So I would just skip these 2 points and then go right to the next one. In this case, it was November 7th to Monday, the 12th of December. And one more. So I would say on average, it takes about 4 weeks for these bounces to reach. And then you don't even need to draw another one if you didn't want to. You can just move this over here. And you can see I'm just from practicing this, I can estimate it pretty well. I have my bounce off the bottom channel or the bottom trend of the channel pretty spot on to the expected time frame it will take. So I'm expecting on Friday, February 24th, give or take a couple days, that DraftKings price should be 1136. And that's valid so long as we stay within this channel. If we have a candle that comes up, I think the highlighter might be better for this. If we have a candle that comes up and closes above this trend line, so say we have a close right, that didn't really work, did it? Say we have a candle that comes up and closes like this. This yellow candle here would invalidate my trade because it's above the top trend line of the channel. The next candles could come back down, so they could do something like this and then re-enter the channel. At that point, you either invalidate the channel because you had a break of it and then price action just happens to come back down, or you go and redraw it. It's easier on the flat ones where you're not drawing it in yourself, but price action can also do something like this. Let me delete these really quick. So it breaks the channel and then just continues up like this. So you don't want to be bag holding puts in this case. Because I'm expecting a rejection down, it invalidated my channel. I don't want to be bag holding puts hoping that it comes back down. I only want to be in the play if I know or if I'm confident that it should continue downward in this case. And then let's say the price of DraftKings does come down to the bottom trend. I do the same thing. Just grab this time frame here, move it on over to this one. And I'd say if it hits this bottom trend, by March 23rd, we should be back at the top, and my price target will be about $17 flat. So I would enter, if DraftKings current price was $11.20, I would enter $15 to $17 call for March 30th expiration, at least over March 23rd. So you can give yourself a little more leeway if you need to, if it takes a little longer for the price to get up there. you always want to have more time than you should rather than cutting it close. So on minimum, I would say this, since this is the shortest rejection from top trend line to bottom, minimum you would want to be in at least 3 weeks out. Maximum you would want to be, I'd say, because this is the longest bounce here, maximum you would want to be 6 weeks out. So to play this channel, you would enter every time it taps the top or bottom. If it taps the top here, I would enter puts for 5 weeks out, 4 to 5 weeks out for $12, $13. Same for the bounce up. I would enter calls for 5 weeks out for $15 to $16. And just, you're expecting the price to go up, so you don't need to get at the money. You can if you want to. That will obviously increase your dollar gain, but you'll have a smaller percent gain. If you enter further out strike price, you'll have a higher percent gain but lower dollar gain.
Your mom's out.
But I'll conclude that there. And for homework for this time around, I'll open the Soxal one after this. For homework this time around, go ahead and chart and find 3 channels and 3 trends on different charts. So one like here on Octa, whatever time frame you want to go on, it can be the 5 minute to the daily. Go ahead and chart 3 trend lines, or 3 trends, and then 3 channels. Remember that the channels are parallel lines. The trends they can be 1 line, they can be 2, but they're not parallel.
Mm-hmm.
And then I will post the, 1 second, to end the recording here. This is the answer for the significant levels on Soxal. So I put 1487, 1418, 1304, 1228, 1162, 1121, 1054, and 874. And those are the answers for the work from last class. Now that will conclude this lesson. Next week we have chart patterns, so head and shoulders, cup and handles, ascending triangles, ascending wedges. And then the week after, supply and demand, and then 5th week will be covered calls. And go on for there. But that concludes this lesson. Now I'll open it to questions.